Stock markets exist for a reason, although it can be tough to remember when your eyes are glued to the tape. The whole point is that they let you raise money to build a business. That business grows. The shareholders are rewarded. Capital growth stream, dividend stream. But what happens if the market can no longer fulfill that function? I think that's actually what we're seeing right now, and it's not good. So let me explain. Until recently, you had three kinds of investors. You had large investors, called institutions. You had small institutions, and you had individuals. The large institutions both traded and owned stocks. The smaller institutions tended to buy stocks and generally own them until something might have changed. As for individuals, mostly they bought and held. That's what nearly everyone in the business told you to do. Buy and hold. Never buy and homework, by the way. Now, over the years, the large institutions have practically traded themselves into oblivion, racking up big fees that produce suboptimal returns for their clients. Hedge funds, meant to perform well in good and bad times, have been serious underperformers, at least on average. Don't take it from me. Warren Buffett holds these truths to be self-evident, and he's written about it extensively in his annual letters. The smaller institutions, they've tended over the last 20 years to see a lot of mini crashes, real crashes, scandals. They've adopted a different mantra. It's that the stock market's become too dangerous an asset class. So why don't we err on the side of bonds? Why not? Bonds are safer. People who own them have actually made a killing at them. Perhaps the biggest shift has been with individual investors, though. These days, the conventional wisdom no longer tells you to buy and hold stocks. Instead, you're told it's too hard, so you should put your money in index funds. That's the new gospel, and when I say gospel, I mean it. Do not get me wrong. I love index funds. If I see on Twitter tonight that I blasted index funds, I'm going to come after you with everything I have. I think a nice low-cost index fund that mirrors the S&P 500 is a perfect place for your retirement money. But if you have the time and the inclination to do the homework, I think you're also capable of picking good stocks. I don't think you're too dumb to do that like most people do. Still, think about the situation we find ourselves in right now. Large institutions are tripping over their own feet. Small institutions are fleeing from the stock market into the bond market. Individual investors have little interest in individual stocks. So how the heck are companies supposed to come public in this environment? Where's the cash going to come from? 60% of this money in this market is now indexed. That's too much of a good thing. Index funds can't participate in IPOs. I'm going to repeat, they cannot participate in IPOs. They only buy what's already in there, right? It's what's in the index. These are passively managed. That's the whole point. If you invest in an S&P 500 index fund, you know you can't buy an Uber, a Lyft, or a Peloton Smile Direct. You can't. They're not in the index. Throw in the fact that capital keeps migrating from stocks into bonds, you got a real problem here. Now, this situation would be fine if we only had a few IPOs, right? Every once in a while, we had some big ones. But lately, we've had deal after deal after deal, and they're not done. Many of these are big money losers, both to the company's insiders and their new shareholders, and, of course, on the bottom line. So you got to wonder, if everybody's putting their money in index funds or in bonds, who the heck is left to pick up the slack, pun intended? Without institutions and individual investors picking actual stocks, buying the chewies, okay, it's become much harder for companies to raise capital. Maybe Charles Schwab's latest move to give clients commission-free trading will save the stock-picking business. I don't know. Maybe there will be enough good IPO winners like a Zoom Video, Pinterest, well, and yes, Beyond Meat, even though it shouldn't be, to save the day. But honestly, here's what I think's happened. I think we're approaching a day of reckoning here, where private companies better start recognizing that they may be better off staying private unless they are desperate. If investment bankers keep pumping out junk, we really dodged a bullet, by the way, with that Uber Desperado WeWork IPO. Sooner or later, there'll be no place left to put it. Judging by the performance of these recent deals, it feels like we're almost there. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.